Uh, Good evening once again, and welcome back in the second week of this Income Tax Act 2025 section-wise course. Uh, we have before us one of the most senior most members of this income tax in the income tax space, Shri S.K. Tulsian. We are grateful to sir for sparing time. Friends, before I introduce Shri Tulsian, I would like to put on record and state that very recently sir has helped us out with a very, very difficult case relating to our own Chamber of Commerce, wherein the income tax department, they were questioning the age-old exemptions certificates. And I would also like to state that the way sir has handled that case, such a difficult case, and sir was very confident from day one, and I can show you sir's message even before starting the representation. Sir says you relax and go to sleep. So with this kind of authority, for all of us, we would be taking copious notes as sir deliberates over today and tomorrow on the sections and the chapters which has been provided to sir. So although sir needs no introduction, still I will read out briefly sir's profile. He is a leading lawyer in tax practice in the country and appears before the Income Tax Appellate Tribunal in almost all benches in the country. He has a very wide practice in direct taxes and is retained by reputed and renowned corporates for advices and guidance. He is presently the President of Income Tax Bar Association 1924 in Calcutta. He is also the President of Tax Advocates Association of Bengal. He is also a member of the Disciplinary Committee of the Bar Council of West Bengal. He is regularly invited as speaker in various workshops and conferences and contributes large number of articles to various journals. Large number of cases represented by him before ITAD benches are regularly reported in various tax reports and journals and are cited as precedents. And he is practicing as an advocate for the last 50 years. So let us welcome sir, those who are present over here and online, with a huge round of applause. Over to you, sir.
It's a great privilege to be here amongst all of you, being the attendees in the oldest Chamber of Commerce in the country. This Chamber of Commerce has a reputation of its own and has seen the history of Calcutta right from the days of Lord Clive. You have a very worthy chairman of Taxation Committee, Mr. Vivek Jalan, who has been so wholesome in praising me for such a small act of mine. In fact, I must say that a wonderful groundwork was done before the case came to me. The basics which required was the registration of your institution as a charitable institution within the meaning of section 215 of the Income Tax Act, read with section 12A and 12AA. In fact, right in assessment year 74, 75 and 75, 76, this issue was addressed before the ITAT and a favorable order was authored in your favor by the ITAT. That order remained unchallenged. Thereafter, again in assessment year 2011 and 2012 and 2013, this issue came before the tribunal, and that also found a favorable verdict from the ITAT, which also remained unchallenged. In spite of that, the department was actually in dilemma in assessment year 10-11, when they thought that since a formal order of registration was not passed in your case by the Commissioner of Income Tax, that required to show that actually you are not a registered institution under Section 12A. In that event, we stepped in to say that I was already registered and recognized by a higher authority, that is ITAT. And that being so, there is nothing for me to argue more. I rely upon those orders to say that I am a registered institution. My declaration before the department while re-registering it under 2021, that I am a registered institution 12A was not a wrong statement or a misstatement. So therefore, I required registration. So my case being a covered case, the tribunal thought it fit to rule in my favor. For such a small gesture of mine, Vivek was so wholesome in praise, although he himself is such a competent, hardworking, intelligent and sincere boy. So very nice to be amongst you people. With these words, let us start today's deliberation, wherein we will cover the 5 chapters of the 2025 Income Tax Act. I'm sure that in last 3 days deliberation, the issue relating to the basics of the new act has been already explained to you. It has been already, must have been brought to you, the tax year concept, that the region which led to the enactment of this 2025 Act, and the various other regions which ultimately led to the tabling of this bill before the Parliament and referring it to the Select Committee. And then after Select Committee's recommendation, the changes made therein, this has been enacted as a law, the 2025. So after 1/4/2026, this law will start operating for the purpose of accounting year 26-27, and there is the saving, repeal and the saving clause in 539, wherein this issue of the past being 536, wherein the enactment being live as far as 1961 Act is concerned in relation to the past proceedings shall continue. It means this new law which has been enacted in practical terms will actually come into operation after 2 years, that is after the filing the return for tax year 26-27, when that shall be processed and done. But in spite of that proceeding, both the laws shall run parallel, because there will be huge number of assessments pending for at least another 2 years from the end of March 2026, and there will be lots of 148 coming in relation to those periods also. There will be lots of appeal which are pending, there will be lots of tribunal which are pending, there are lots of matter pending in the High Court and the Supreme Court. So therefore all these will see it the order of the day in the years to come under the old law only. So therefore the old law will continue to have force as per this 536 of, and there are basically the 6 grounds given in section 536, which are the saving clauses. And these saving clauses, Vivek must have explained to you earlier while discussing. So therefore, I shall not dwell upon that and necessarily kill the time of this esteemed gathering. So therefore, I shall skip that. Now today, I am seized with chapter 8, chapter 9, chapter 10, chapter 9, chapter 10, chapter 11, chapter 12, chapter 13, chapter 13. So I am seized today with 1, 2, 3, 4, 5 chapters. And these 5 chapters comprises of earlier chapter 8 and chapter 9, which is now chapter 9. And chapter 8 earlier had rebate and relief, 87, section 87, 87A, 89 and 89A. And chapter 9 had double taxation relief, that is section 90, 90A and 91. Now this is in chapter 9, rebate and relief. Rebates and relief in section 155 to 158. and double taxation relief in section 159 to section 160. Then we will deal with chapter 10, wherein the special provision relating to avoidance of tax, that is section 92, 92A, 92B, 92BA, 92C, 92CA, 92CB, 92CC, 92CD, 92CE, 92D, 92E, 92F, 93, 94, 94A, 94B of 1961 Act, which is now in section 161 to 177 of the Income Tax Act will be dealt with. Chapter 10A also is now in chapter 11, because that is earlier it was 95 to 102, it is 178 to 184. Then we are dealing with chapter 12, which was in chapter 20B earlier, that is requirement is to the mode of acceptance and payment or repayment in certain cases to the counteract the evasion. It was earlier in section 269 SS, 269 ST, 269 SU, 269T and 269 T. Now these are comprised in section 185 to section 189 of the new law. Then we have this chapter 13, which was earlier chapter 12, chapter 12B, chapter 12BA, and chapter 12, and chapter 12A, and chapter 12AB. These chapters are now comprised in chapter 13. The chapter 13 is subdivided into 6 parts, that is part A, part B, part C, part D, part E and part F. So this is then there were also chapter 12F, 12FA and 12FB. All these are now in chapter 13. So these are chapter, the part A comprises of determination of tax in certain special cases, that is comprised in section 190 to 195. Part B is a special provision relating to capital gain, section 196 to 198. Part C is a new tax regime, that 199 to 205. Part D is a special provision relating to minimum alternate tax and alternative minimum tax, comprised in section 206. Part E is a special provision relating to non-resident and foreign companies, 207 to 220. Part F is a special provision relating to pass-through entries, 221 to 224. Then we come to this chapter 12G, which is a special provision relating to income of shipping companies, which is in part G, which is a special provision relating to the income of the shipping companies, 225 to 235. So these are the basic changes which has been come in 225 Act in age against the chapters which contained in the old Income Tax Act 1961. Now if we start with chapter 9. Chapter 9, overview of the reform in chapter 9. A structured location. A structured location as per Income Tax Act 1961. If you have the note given by me? Yes. Now if you turn to that, chapter 9 to 13 is the headline. And chapter 9 of ITA 2025, headline is rebate relief and double taxation relief, section 155 to section 160. Overview of reform in chapter 9, rebate relief and DTA provisions. A structural location. In 1961 Act, sections are spread across various chapters. Chapter 8, rebate and relief, 87, 87A, 89 and 89A. Chapter 9, double taxation relief, section 90, 90A and 91. Now they have been consolidated in section 155 to 160. Within this is one consolidated chapter 9. This consolidation is modern drafting. It is basically a very simple drafting to be understood by everyone. Terminology, earlier assessment year, now tax year. So tax year has been modernized, means 1st April to 31st March will be the tax year. Legacy provisions, contained obsolete cross references, outdated rebate schemes. Now it is removed. legacy clutter, rules shifted to delegated legislation, cleaner policy architecture, DTA mechanism, split between sections 90 and 90A. Now it is combined in section 159, Unified Treaty Framework. In fact, I am speaking before Vivek, he has already written a book on it. He must have done all these homework in his book. So, had he sent me this book before, it would have helped me to come still better. Now, overall comparative mapping, chapter 9 to 2025 versus legacy provision 1961. General rebate, section 87, now section 155, renumbered, integrated into chapter 9. Rebate for resident individuals, 87A, section 156 now, expanded rebate structure includes tapering and mechanism under the new regime. Relief for salary and pension arrears, earlier section 89, now it is 157, clearer drafting. Foreign retirement accounts, section 89A, section 158 now, more structured definition aligned to global standard. I am just making these brief references because if I start stating about the entire chapters, then each chapter will consume the whole time. So therefore, and all you people are professionals, so you will understand that is why I am giving you a summary picture of the things which has happened. So now this foreign retirement I have told, DTA framework, section 90 and 90A, it is now section 159, merged, a stronger and anti-abuse. Countries with which no agreement exists, earlier section 91, now section 160, modernized, certain special cases removed. Now come to this part A of chapter 9, that is section 155 to 158, rationalize the law on rebates and relief by consolidating the legacy provision into a clearer, modern framework while the foundational relief principle remain intact. The 2025 Act introduces enhanced and tapered rebate under the new tax regime, improving equity and reducing abrupt tax outcomes. Now let us examine this. Now rebate for resident individual. You all are aware, 87A, 100% rebate of tax on 12,500 which came in the last budget, available where the total 5 lakhs, no tapering mechanism, rebate capped at the actual tax payable, budget 2025 under the 1961 Act in the case of person opting under the new regime, under section 115 BAC, the limit of rebate was enhanced from 25,000 to 60,000 with the increase in threshold limit of taxable income from 7 lakh to 12 lakh for assessment year 26-27. That was the last budget amendment. Same basic rebate continues. Section 156 read with section 202 new regime. Income 12 lakh, rebate 60,000, 100% of tax. Tapering 156.3, rebate reduced by income exceeding 12 lakh. Rebate cannot exceed the tax payable. These are the, practically there is no change to that 2025 budget which amended the Income Tax Act. So though major expansion of relief under the new tax regime, tapering removes, cliff effect, principle against negative tax retained. Now relief for salary arrears, advance salary, family pension, section 89 earlier, relief available for salary arrears and advance salary, proviso to section 89, subsection 2 of section 157, no relief shall be granted if the SSC has already claimed deduction of such amount, tax recomputed by spreading income over relevant years. Now this is section 157, same relief mechanism retained, subsection 2 of section 157, that is a proviso to section 89 under 1961 Act, that taxpayers are required to refer under section 19(1), table serial number 12, to see what deductions are covered under said subsection. Family person relief placed in separate subclause, computation method unchanged. So substantive relief unchanged, clearer statutory structure and easier navigation. Now, relief for income from overseas. This is a retired person who settled in India from foreign countries. Earlier section 89A applies to the specified person, that is returning NRIs from foreign retirement account, covers a specified foreign retirement account in notified countries, taxation aligned to the year of withdrawal via rules and notification. Now it is section 158, same scope in eligibility retained. The definition of a specified person, account and notified country codified, cleaner drafting, rule-based operational framework continues. So this also there is no policy change, modernized drafting aligned with global retirement system. Now come to part B. Part B, double taxation relief, which is section 159 and 160 of the of the Act 2025. Part B of chapter 9, section 159-160 consolidates India's double taxation relief framework by bringing treaty-based and unilateral relief provision into a streamlined, globally aligned structure. While the core relief principles remain unchanged, the 2025 Act strengthens anti-abuse safeguards, improved enforcement clarity, and removes outdated legacy provision. Now you see, I am reading from the note because I do not want to miss out on the amendment provisions. Because if I give you just a lecture, then you will be lost as to what has actually come into. And these notes I am giving so as it you can refer to it in future also while understanding the changes which has come in this act. Now 1961 Act versus ITA 2025, chapter 9, part B, treaty-based double taxation relief, DTA framework. Section 90 earlier, agreement between India and foreign government. Section 90A, agreement between a specified Indian association and foreign specified association. Two parallel sections governing treaty relief. Now it is section 159, single consolidated provision covering government to government treaties and association to association agreement. Now all these association to association agreement are ultimately notified by the government of India. Because without notification, the association to association agreement will not cover double taxation. The major structure consolidation eliminates duplication and simplifies the treaty navigation. A scope of treaty agreement, a split attaching different legal bases to section 90 and 90A. Now it is combined scope under one section. Unified framework improves certainty and consistency. Anti-treaty shopping abuse prevention, limited to original text, strengthened over time through amendment, that is LOB clauses. Explicit and stronger anti-avoidance safeguards embedded, aligned with the OECD BEPS framework. Now this is because this comes to the latest OECD requirements. So therefore, this is a big improvement, clear legislative intent to curb treaty abuse, reduced reliance on the piecemeal amendments. Then exchange of information and cooperation, present but spread across provisions, protocols, now clearly articulated obligations with section 159. Now better global compatibility and transparency, tax recovery and enforcement assistance, less explicit statutory backing, now enhanced enforcement and recovery mechanism. It strengthens cross-border tax administration. Now unilateral relief where no DTA exists. Section 91, relief available to Indian residents earning income from non-DTA countries. Section 160, same unilateral relief mechanism retained. Even where we do not have the treaty, the assessment-based income gives credit for the taxes paid therein and the deduction permitted therein. So therefore, this is a beneficial provision in section 91 where even the treaties are not there, which has been fully retained. Then reference provision for treaties. Section 91 referred to section 90. Now section 160 refers to section 159, same provision, updated internal cross-reference reflecting consolidation. Then a special relief for agriculture income from Pakistan, this is not required, so this has been removed. Then drafting and legislative style, conventional amendment-driven language, clearer, modern, simplified drafting, easier interpretation and application. Overall policy intent, prevent double taxation, promote cross-border trade, same policy retained with stronger safeguards, no dilution of taxpayers' relief, sharper compliance and focus. Actually, when you go through the 2025 provision, you will find that the government focus was not to change the law as much as to streamline it. Because 1961 Act over a period of time has been amended several times from time to time in order to meet the government policy decisions. Lots of amendment in the act were made, lots of reliefs were granted, lots of exemption provisions were brought in, lots of other changes were effected which today has become obsolete. As such, that Act 1961 looked very heavy. When you opened it, half of those sections were not relevant at all. So therefore, this 2025 Act actually has been enacted in order to do away with those obsolete provisions and bring it a harmony with the functioning clauses so that the Act does not have a legacy which unnecessarily is burdened with those sections which have no value at all. Now we come to next chapter. That chapter is over. Now we come to chapter 10. A special provision relating to avoidance of tax, section 161 to section 177. Now these are actually transfer pricing provisions. You know that transfer pricing provision in the international transaction with the associate enterprises has got huge value, and there has been lots of controversy in relation to that. That is how lots of changes also has been brought in earlier, and then the effectiveness of that is gradually being established. So this chapter is, and moreover you see most of the companies now operating in India has associated enterprises brought. Be it China, be it UK, be it Hong Kong, be it Singapore, be it other places. So lots of associate enterprises are functioning and there are transactions between them. So the transfer pricing is a very important component of the evaluating the anti-abuse provision of the Income Tax Act. Now this is chapter 10 of the Income Tax Act 2025, consolidates and modernizes India's transfer pricing and anti-avoidance framework. While the substantive rules are retained, the provisions are recoded and streamlined with clearer definition, improved placement of SDTs, a stronger administrative mechanism including multi-year analysis, safe harbor, APH and secondary adjustment. Chapter 10 places greater reliance on rules for procedural detail. Now what are the features? Features are transfer pricing ALP principle, old section 92, new section 161. Now section 161 fully preserves the arm's length principle for international and specified domestic transaction, including cost sharing and the anti-abuse bar on reducing income or creating losses. The change is purely structural. A scattered provision and explanations are consolidated into 4 clear subsections covering income, expenditure, interest, allowances, and SDTs, improving clarity and reducing interpretational disputes without altering policy. Now this section is become the sole section where everything is very clearly defined and explained. So this will be very easier now for everybody to arrive at the transfer pricing figure.
associated enterprise. Section 92A. Now section 162. Section 162 retains the AE definition and all deeming test, management, control, capital, shareholding, loans, guarantees, board control, IP dependence, exclusive dealing, common control, partnership interest. The evolution is drafting and integration focused, clearer structure, explicit linkage with SDTs, updated cross references, and OEC BPS aligned clarity with no change in scope. विवेक जी कहीं पर अगर हम मिस कर गए हैं तो आप बोलिएगा. इंटरनेशनल ट्रांजैक्शन
सर एक इसमें ये है if you go through this 162 sir 162 which refers to 92A
Correct.
they have changed the structure a bit.
करेक्ट
92A it included 92A1 which had two clauses. If you see here sir
यस यस यस
this is 92A. One, two clauses,
Correct.
A, B.
करेक्ट
Now, and thereafter they're deeming fixture 92A2
करेक्ट
with 26. But now they have done this 162.1, it has three clauses. This 26% is also merged, 26% of the shareholding, if there is, then it
Yes,
becomes
yes.
an AE. Sir, any reason, was there any earlier litigation on this for which they have done this?
Actually, transfer pricing provision came in the statute in the year 2002,
Right.
when the international transactions became the order of the day. Gradually, from time to time, changes has been incorporated, and there has been lots of confusion. So unless you lay down a clear framework for identifying associated enterprise, this confusion and litigation will continue. It is for this reason alone. Probably they have brought in the clear-cut mandate in respect of associated enterprise.
Okay.
I think I find no other reason.
Okay.
So therefore, you see what they have done, scattered provisions or disputed provisions, they have all brought in under single section and subsections, so that everything is defined within the framework of that section and becomes a part of that section, giving a clear vision of what the section requires. So that is why I have said that what is this retains the AE definition and all deeming test. What are deeming test? Management, control, capital, shareholding, loans, guarantees, board control, IP dependence, exclusive dealings, common control, partnership interest. So these are the type of the interest which creates associated enterprise. So the evolution is drafting and integration focused. Clearer structure, explicit linkage with SDTs, updated cross references, and OECD BFS aligned clarity. Now you have got more clarity on OECD account also. So with no change in scope, the scope has not been changed, but clarity has been brought. Now come to the international transaction definition, 92B, section 163 now. Section 163 carries forward the same coverage of international transaction. The key refinement is explicitly stating that at least one party must be a non-resident, removing ambiguity. Coverage of tangible, intangible property, financing, services, restructuring, cost sharing, and profit impacting dealing remains unchanged, with sharper drafting for intangibles. So intangibles has been clearly identified, and everything is now clear. The language is simple. That simplicity in language removes ambiguity, removes the scope for fresh interpretation. So that is how I appreciate the drafting of section 162 and 163, because these two sections earlier, 92 and 92B, as Vivek ji underlined, has been the biggest reason for litigation under the transfer pricing regime. Now come to a specified domestic transaction, SDT, section 92BA, which is now section 164. Section 164 preserves the SDT regime unchanged, same objective, 20 crore threshold, and transaction categories, profit link deduction, SEZ benefit, concessional regimes. Changes are structural and referential only, updating section numbers and placement for clarity with no expansion or contraction of scope. Determination of ALP, section 92C, now section 165. For more detailed discussion, you can call me later where we can discuss section wise,
In detail.
because today we are in a time frame. In that time frame, I have to deal with all the chapters which has been given to me.
Right.
So I have to be concise in my words and to the point as far as the issues are involved. So ALP determination. Section 165 retains the entire ALP framework. 6 methods. Most appropriate method rule, 3% tolerance, and AO powers where pricing and documentation is deficient. Provision is redrafted for clarity with updated cross references and an express safeguard against double taxation on corresponding adjustments.
Can you give the mic over here?
You see, the appropriate rule is the 3% tolerance, 3% tolerance. If it is more than 3%, it shall be taxed. So tolerance is only 3%. Earlier also it was 3%.
No, sir, earlier it was plus minus 5%.
Yes.
But very recently it has changed. If we have more than 6 comparable companies, then it is a 35 between, it has to be within the range of 35 percentile and 65 percentile. If our means means our value comes within that range, then also it is at arm's length. That way we are doing. But
True.
5%
See,
tolerance is not there now.
The tolerance limits are all specified in the notification also. So therefore, as far as this 3% tolerance in the statute is concerned, that is with reference to the prices with which you are buying or you are selling. So if the difference is above 3%, then it shall be brought to tax. So there is complete clarity about that now. Now reference to TPO, when to refer? Section 92 CA, section 166. Section 166 continues the TPO reference framework with administrative refinement. Key enhancement include clearer subsection, updated cross references, a multi-year ALP option from assessment year 26, tax year 26-27 to reduce the repetitive litigation and expletive exclusions adjustment from below book assessment in such cases. Substance remains intact. Power of board
Sir-
to make safe harbor
Sir,
rules.
just one question over here in relation to 92 CA and 166.
Yes.
This multiple year ALP option,
Yes.
I think 3 years, this has come from this assessment year,
Correct.
26-27.
Correct.
So sir, suppose my assessment is happening today and the assessing officer, he determines my ALP for 3 years. So will he determine he will determine under ITA 61 and for 2 years will fall under ITA 25. So will that prevail in ITA 25 also, the ALP determined in ITA 61?
See, basic provisions remains the same, but that is a gray area. That's a gray area because a order passed under the 1961 Act should be relevant for all proceedings under the 1961 Act. As far as the new Act is concerned, you can always ask your assessing officer to re-evaluate it, because the Act is different, the section is different, and the assessment will be under a new Act. So, but it's a gray area, because the provisions as contained in section 92 CA more or less remains the same under section 166 also. But I feel that your query on this has lots of substance, and to my mind, in that should not continue in the under the 2025 Act, something which has been determined in under 1961 Act. Now the power of board, I told you, under 92 CB is in section 167 now. This 167 continues the safe harbor regime. Prices, income declared per rules are mandatorily accepted, reducing disputes. Changes are drafting led, aimed at clarity and modern administration. Effectiveness depends on CBDT notified rules. So I have said this, that CBDT notified rules will be giving you the effectiveness. So this is where the chamber has to step in.
Yes, sir,
And
we have.
Yes, chamber has to step in. It's your job now.
We have already given
Yes.
our suggestions on the rules.
Yes.
And Linde is here. You also kindly give your suggestions on the rules.
Yes. Now, advanced pricing agreement, APA, section 92 CC, section 168 now. Section 168 retains the APA framework unchanged. CBDT powered to enter binding APA's rollback, 5-year validity, and voiding for fraud differences are structured with updated cross references in modernized terminology only. So this is almost the same which used to be under section 92 CC. Giving effect to the APA's modified returns and assessment, section 92 CD, now section 169, preserves the APA implementation mechanism, modified return within 3 months, limited to APA adjustment, alignment of completed and pending assessments, and unchanged limitation period. Changes are purely structural, fitting APA into the reorganized assessment structure. Now secondary adjustment, section 92 CE, section 170. Section 170 continues the secondary adjustment regime, 1 crore threshold, repatriation requirement, deemed advance from interest on non-repatriation, and option to pay additional tax in lieu of interest. Consolidation brings clarification into the main text without any policy change. Now come to TP documentation, section 92D, now section 171. Section 171 retains documentation obligation unchanged, a scope 8 years retention, furnishing on demand and non-compliance consequences. Changes are administrative, consolidation updated, cross-references, delegation of procedure to rules and penalties shifted to a separate section, improving clarity and flexibility. Each of these comments are based after reading the changed law. We have taken enough time
Yes.
to prepare this note. So therefore, every word which I am emphasizing has a basis. Accountant's report, Form 3 CEB, section 92E, now section 172, continues the accountant's report requirement for international and SDTs. SIPT is procedural. A principle-based provision with the details moved to rules for flexibility and digital compliance. Penalties are consolidated under section 447. Definition relevant to ALP, section 92F, now section 173. Section 173 reorganizes and simplifies TP definition with no substantive change to key concepts. ALP enterprise P drafting is streamlined. Accountant is no longer defined here. Changes are structural, reducing litigation risk. Only accountant is no longer defined. Avoidance via transfer of income to non-resident, section 93 and now section 174. Section 174 reenacts the same anti-avoidance rule. Income transferred to non-resident but enjoyed by the resident is deemed taxable to the resident with the bona fide commercial exceptions retained. Changes are drafting only. Now come to dividend, bonus, interest stripping. Section 94 and which is now section 175. Preserves the anti-avoidance outcomes, loss disallowance for dividend, bonus, stripping, deeming rules, clearer exclusions, cost adjustment and burden of proof. The provision is restructured for clarity, separating rules into subsections with updated references. Notified jurisdictional areas, NGA, section 194A, now section 176. 176 continues the stringent NGA regime, deemed age, international transactions, deduction denial, highest rate TDS including 30% and deemed income for unexplained receipt. Changes are structural, preserving full rigor. Thin capitalization, section 194, section 94B, now section 177. Section 177 retains thin cap rules unchanged, 1 crore trigger, 30% of EBITDA cap, 8 years carry forward and expulsion for banking, insurance with clearer carve outs for IFSC finance companies and notified NBFCs, policy continuity and refined drafting. That ends the TP regime. Now we come to another chapter, that is general anti-avoidance rule. I think these sections are so important that clubbing it with the 5 chapters you have given me is injustice to this chapter because under the new regime, this chapter will be used very frequently. Because now cash regime is gone. All regimes has to confine to the banking transactions and transfer of income through the modes which are very general, in the form of purchase, sale, commission, service charges, etc., all these things. Then merger, demerger, then slump sale, etc., all these things you see will be a common areas where this anti-avoidance, general anti-avoidance rule will step in. So there is a very huge requirement to enlighten your members as to how to conduct their business and the transactions so as not to fall in the trap of general anti-avoidance rules, because what is written in the letter of law here is not enough. There is a need to understand the matter by referring it to the international laws and the case laws and the Supreme Court judgments to explain as to what type of arrangements fall within this chapter. But now I shall confine it to the literary part of it only. So I am going ahead with it. Now you see, GAR is a substance over form anti-avoidance regime and targets abusive or artificial tax arrangements. The 2025 Act retains the same substantive GAR framework is the 1961 Act. The changes are largely structural, renumbered, cleaner drafting rather than doctrinal or substantive. Now, statutory location of GAR chapter earlier was in section 95 to 102, which is now in section 178 to 184. Applicability of GAR was in section 95, it is in section 178 under the new law. Impermissible avoidance arrangement were defined in section 96, now in section 179. Arrangement to lack commercial substance 97, now section 180. Consequences of impermissible avoidance arrangement 98, now it is 181. Treatment of connected person and accommodating party 99, now it is 182. Application of this chapter 100, now section 183. And interpretation 102, now section 184. Now, the core legal test for GAR, core rule, an arrangement is impermissible. Both conditions are satisfied. One, main purpose is to obtain a tax benefit. This itself is a very vague sentence. What would you call a tax benefit and intention to tax benefit? Because there are many situations in the business where benefits are coming, but these are not coming because of any calculated arrangement. These happen. All of a sudden it happens. Some international events leads it to happen. Some local events leads it to happen. Change of regime leads it to happen. The all of a sudden rise in the price of dollar leads it to happen. So there are so many situational things which leads it to happen. So to say main purpose is to obtain tax benefit is too naive that these literal word should drive you to this chapter. So therefore, what are the situations which will not lead you to this chapter? That has to be understood and that has to be properly coded and kept in record, because each management has to instruct its staff as to when such benefits are obtained or received, and there are reasons for that. Such reasons should be kept on record along with the evidences, so that we do not fall under this anti-abuse provision. Then second is, any one tainted element exists, noted arm's length. That is fine, arm's length is defined, no issues about that. Misuse or abuse of law, this is again a very vague area. Misuse or abuse of law. A law is there. If I have used that law and I am as per law, still it can be called misuse of law. If I have used the law and I am very much clear that I have followed the law, it can still be abuse of law. So this is again a very vague area. Lack of commercial substance, that is another thing. Sometimes there are such transactions where there is lack of commercial substance. A company is in need of huge sum of money, all of a sudden they have to make a distress sale. So there may not be commercial substance in that, but that money is important for them. Therefore, they have to sell to a person who is available to purchase. So this distress sale cannot be called lack of commercial substance. So then non-bona fide manners. Now this is something, what is bona fide, what is non-bona fide, it is not defined so far. So there is need for a clear notification from the board to provide as to what is bona fide, what is non-bona fide. Otherwise you see that doing business will become very litigated. So therefore, such GAR provisions,
Sir, one thing over here.
yes,
You said very correctly that these are so vague, and corporates and taxpayers have to keep documentation rightly. Now, I'll give one example. You know, say I am getting my, I am a subsidiary in India. My holding company is in country A, but I am getting my product made from the main technology of company A in another company B, and then I am importing. I am within my rights to either do a pure purchase sale agreement or just to take a service from company B,
correct.
works contract
Correct,
like you say.
correct.
Now I go into simple purchase sale. A sells to B, B sells to me. The assessing officer, he says, no, it is a works contract. And you are just taking a service so that country B, he also becomes your related party. Now, what document to keep in these kind of circumstances?
See, the instance which you gave, in that there is a principal located abroad, you are a subsidiary functioning in India, and you have got yet another company lying in another territory, and you have got the technology, and that technology leads to the production of the goods. So
Yes.
the technology is owned by you,
Yes.
and you are providing the technology to that another subsidiary which is located in yet another country who is manufacturing for you.
No, he is not my subsidiary.
Acha, even if it is not a subsidiary, so if it is not your subsidiary, then you do not fall under the transfer pricing regulation. But since you are providing the technology, and on your technology he is constructing it, so there is a very clear case where you can go for the works contract. Because, or you can provide in the technology, you can charge for that, and you can purchase it. So there has to be a clear drafting of the agreement where you are charging royalty and you are charging fees for technology from the said party, which is you are disclosing as your income, and purchase and sale is done on the international pricing, because the technology price he has already paid, royalty he has already paid, so therefore he can charge the market price from you. So therefore I think if you maintain this clarity, then the scope for misinterpretation can be removed.
Agreement has to be worded.
The agreement has to be clear. You have to charge royalty, you have to charge for fees for technical know-how. Both these you have to charge from them, and then you can clearly say that he has purchased this technology from me, and under the royalty granted to him, he is producing the things. So therefore he is right to charge market price from me. So therefore it is clear purchase and sale. It is not works contract. Now presumption step transaction doctrine. GAR may apply even if one step in a multi-step arrangement yields tax benefit. This is such a dangerous thing. You see, unless these things are properly clarified and notified by the board, doing business becomes a nightmare. Means you are completely at the mercy of the concerned officer, because it may lead to huge demands which has to be, will be settled till the Supreme Court stage. And till that time, all the years, you will continue to suffer. So therefore, GAR may apply even one step in a multi-step arrangement yields tax benefit. Now, you rightly pointed out a situation where you have not charged royalty, you have not charged fees for technical services. You have clearly purchased and sold, and you have actually purchased at much lesser value because you have provided him the technology and you have also
Yes.
given him the brand.
Yes.
So that is why you are purchasing at a lesser value.
Yes.
But there, the benefit which you are getting, you are actually sacrificing your royalty and fees for technical services. So you are not getting any benefit. But at the same time, one step one step in a multi-step arrangement can lead to you to in GAR. You just understand. Actually, this is such a vast thing. If I start talking about this, then whole time will be spent on this only. So I'll not go into all these things. Now, burden of proof shifts to SSC to establish bona fide commercial purpose. So again here, you have to properly guide and advise that bona fide, the proper note for such transactions should be kept, which will explain the bona fide of the transaction. So then come to the procedural safeguards. Now monetary threshold is the tax benefit which exceeds 3 crore. Very small. I think it should be raised to 30 crore. 3 crore is a very small, a small entrepreneur will come into it. So in a country where dollar price is almost 90 rupees plus now, where is the 3 crore? It's a very paltry sum. Procedural safeguard, multi-tier approval mechanism. You should write Vivek ji on this 3 crore threshold.
It represents.
Procedural safeguard mandatory, multi-tier approval mechanism. AO issues show-cause notice, reference to the principal commissioner as per rules, approval by the approving panel, and GAR invoked only after approvals. Now these are the authorities through which the final undertaking GAR will be done. But I tell you, the practical part of it is that if the AO starts it, it's ultimately approved by the PCIT. So that functional autonomy of each unit of the government should have to be ensured. How it can be ensured is something which will require a very coordinated discussion, so that the PCIT's pressure doesn't lead the AO to hold, because normally in GAR, since the amount involved is very high, the AO is always trying to protect himself from vigilance proceeding, etc. So he goes by what the PCIT says, and so what he does, then the PCIT goes on doing that. So that functional autonomy and assurance that any decision taken in favor of the SSC will not lead to the his confidential role or disciplinary
Vigilance.
these needs to be ensured. Then only this functional autonomy of each institution can be ensured. Interaction with the tax treaties. GAR overrides treaty benefits. Even treaty compliant arrangement may be denied relief. Now, you have international transactions. Such international transactions has a framework. There is a separate chapter devoted to it. Now, under what circumstances those guidelines, those provisions will be diluted for the purpose of this chapter? A clear guideline should come. It has to be a case of fraud. It has to be a case of complete misrepresentation. It has to be a case where they have caught hold of the mischief done by them. Just because you suspect, the suspicion should not rule your action. So that part needs to be taken care of. Interaction with tax treaties. Now, drafting and a statutory placement. Provisions inserted over time are spread across chapter 10A, now it is 11. No change. Judicial precedents. GAR case law governs interpretation. There are very few case laws so far, but then we need to have a clarity on each word contained in this chapter. Now we come to
Sir, one more point. You have in your note here, there is written pre-2025 precedents remain fully relevant.
Because I say so because
Sir.
if you see earlier I was also of the view because there is a 1922 Act also. 1922 Act also was almost the 1961 Act is also almost replica of 1922 Act. All the decisions which were taken under 1922 Act we are still cited as precedent. Reopening provisions under section 148 now, earlier under section 34. Calcutta Discount Company judgment, the constitutional bench judgment. What is information? We still rely upon the Calcutta Discount judgment. We still rely upon Calcutta Company judgment, Dhakeswari judgment in respect of what sort of inquiries should be conducted, what sort of opportunities should be granted before framing the assessment. So, I am guided by what I have learned and what I have found in course of time while dealing with the 1922 Act authorities in application of the 1961 Act. If the terms are the same, if the provisions are the same, if the law relying upon these draftings are the same, then there is no reason that those orders should not be precedents for these drafted sections also. As I told you in the very beginning, this 2025 Act is not an act where the basics of charging income tax has been changed. Basics of the charging income tax, the procedure for collecting tax, the authorities who will be functioning and for collecting tax, or the structures of imposing penalty, prosecution, anything has undergone change. They all remain the same. What has been done is that the obsolete sections, the intriguing provisos and explanations have been, you are an author, you must have, in your go through, you must have put it like that. Intriguing provisos and explanations, which were basically taking out the main provision through the explanation, and now has been numbered in section 1, section 2, 1, 2, 2, 2, 3, 2, 4, 2, 4, 8, likewise. So now you can go through that section to find out the outcome. You need not travel to explanation, provisos, etc., etc. So I say so that the precedents on the subject are good laws, more particularly the Supreme Court judgment and the local High Court judgments, because they are under Article 227 and Article 141. They are the good laws. So therefore, if the provision is the same, we apply the law relating to the other statutes also on the subjective interpretation. So those laws are good laws for explaining Income Tax Act also. We under the criminal law, when that loose papers were examined by the Supreme Court and said they are not books of account. You cannot fasten a liability but treating those loose sheets of papers as evidence against the person before and without conducting inquiry and establishing through cogent evidence that can take the form of income. So that provision of the Supreme Court, B.K. Shukla, etc., are still good laws under the Income Tax Act. So therefore, I say so because the law on the subject cannot differ unless the intent is different. In a criminal law, the intent is different. You have to, basically Income Tax Act is a civil law.
Yes.
It does not require just mens rea. Mens rea earlier for imposing penalty And Tata, Steel Authority of India, 62 ITR, they use the word Mansia. But the Supreme Court said no. In this income tax proceeding, Mansia is not important. You have violated the law, your penalty is being imposed for that. Your intent is not to be seen. Whether you did it for avoidance of tax or you have avoided the tax by doing that, will lead to imposition of penalty. So therefore, that part will have to be taken care of. Otherwise, the law declared by the Supreme Court and the High Court will be good law.
Right. Sir, one more
Yes.
in addition to this select committee comments, how strong the comments of the select committee, how much of value will it hold?
See, we refer to in the constitution, when a particular article was enacted, the discussion in the Constituent Assembly is taken which led to the adoption of that particular article. But a constitution is the framework for democracy. A statute is a law when it is passed by the parliament. Yeah, a bill when it is enacted, it becomes law. A bill when it is referred to select committee, it means it has not reached the status of enactment. It is still being discussed, being examined. There can be pros and cons relating to that. There will be amendments in the bill. There will be changes in the bills. Lots of suggestions, pros and cons will be coming. You can sometime say that the object behind this enactment was explained by the finance minister while piloting the bill in the parliament. So the intent behind the enactment is this. That will carry much force rather than the select committee deliberation. Select committee deliberation is a nuance which is yet to, because after the select committee recommendation, the bill is redrafted. After redrafting the bill, it is then presented in the parliament.
Yes.
There may be still amendments to the new bill which is presented post select committee. So this enactment ultimately is a law which becomes a statute. So a statute and constitution are two different things. Constitution is the mother of all laws. The constitution is the document which governs us. A statute is framed in the light of the constitution. What leads to the enactment of Income Tax Act? Article 265 of the constitution. Article 265 of the constitution says the taxes shall be levied and collected as per the authority of law. So authority of law comes from where? From the parliament's enactment. So therefore a statute is different, constitution is different. You may refer to the parliamentary, the constitutional debate while enacting, while formatting an article which led to the formation of article, and can say the whole house, because the constitution was an agreed document, there was not a single dissent. So therefore, when all agreed after discussion, then that article in constitution was enacted. Whereas a statute, lots of workout is there. Even on finance bill there are lots of workout there. So that the select committee deliberation cannot be the persuading force for the courts to have that status. Now you see, I am Now I come to another chapter. This is chapter 12. Mode of payment of certain cases. Now you see, this is, all of you know it, I will not devote much time in it. Earlier section 269 SS, which is 20,000 rupees payment, which was in respect of the advances or loan, which is covered in section 185 now. 2 lakh payment in cash from one person in one day, for one transaction or one event, is covered now in section 186, which was section 269 ST. Acceptance of payment through prescribed electronic made, section 269 SU, now 187. Business ever turnover of 50 crore must provide facilities for UPI, RuPay, debit card and other notified electronic modes. No MDR allowed on such payments. Digital first regime continued. Then mode of repayment of certain loan, section 269T. Now it also, earlier one, the now also applies to profession. Yes, there is a change, section 269 SU. Earlier it would apply to only business. It is now applied to profession also. Now mode of repayment of certain loans and deposits, that is 20,000 rupees. So that continues. Then a specified advances, that is also threshold limit for primary agriculture credit society is 2 lakh rupees. Interpretation of section 269 SS, ST and section 269T 189 defines the key terms governing non-cash payment and repayment of loans, deposits with property linked amounts, while largely carried forward from the explanation to section 269T and of the 1961 Act. The provision introduces the broader concept of a specified sum to cover all receipts relating to immutable property, whether or not the transfer is completed. Now in section 189 ITA 2025 largely retains the definitional framework of section 269 SS and ST of the 1961 Act, ensuring continuity in anti-evasion policy. The key refinement is the introduction of the broader term, a specified sum, expanding coverage beyond advances to all property-linked receipts, along with the consolidation of definition into a dedicated provision for greater clarity. So it has been expanded. Now come to the chapter 13. Now chapter 13 of the 1925 Act reorganizes all special rate taxation provision into a single streamlined framework, while the core tax rate and the principle remain largely unchanged from the 1961. The new Act consolidates a scattered provision relating to exempt income, adjustment, provident fund withdrawal, such cases, GDR income, a specified special income, capital gain and concessional regime into a cleaner and more coherent structure. The result is improved navigation and clarity without altering the substantive tax outcome for taxpayer. Comparison between the chapter 12 of ITA 2025 and the corresponding provision 1961. I have provided it. You people go through it because these are not very complicated provisions. You just can go through it, and I think that largely covers my talk today, because I am almost reaching 7 p.m. now.
Yeah.
So now you can come to the chapter 13. The key factors I will read out,
Yes.
because those are very important. Chapter 13, key takeaways. Come to page 23. Chapter 13,
Last page. Page 23.
key takeaways. Key takeaways. A structural overhaul, not policy shift. Chapter 13 consolidates a scattered, a special rate and a special computation provision into a single coherent chapter, improving readability and reducing cross-referencing without altering underlying tax policy. 2. Capital gain regime simplified as standardized. Introduction of uniform 12.5% long-term capital gain rate with limited grandfathering for immutable property and removal of indexation marks a shift towards rate certainty and simplified asset classification. Equity STCG rate stabilized. The 20% STCG rate on STT paid equity instrument is crystallized as a permanent feature, ending frequent rate changes through annual amendments. MAT and AMT unified. MAT and AMT merged into a single minimum tax framework with explicitly, ये बहुत बढ़िया हुआ है, ये एक ही सेक्शन में सब आ गया. Framework for explicitly codified rates, formula based computation, index alignment and integrated credit mechanics while retaining the 15-year credit carry forward. Then a specified rate incomes codified. Taxation of winning, VDH, crypto, online gaming, carbon credits, patent, royalty and insurance income is consolidated into a unified framework, enhancing clarity without increasing tax rates. Predictability in search and unexplained income cases, the 60% deterrent tax regime is retained, but there is repositioned with clearer statutory articulation, reducing interpretational uncertainty. Pass-through regimes streamlined, venture capital, business trust, investment fund continue as pass-through entities with the definitions and exemptions moved to schedules and obsolete concept eliminated. Non-resident taxation modernized, concessional regimes are preserved but aligned to the new capital gain structure with clearer cross-references and updated terminology. Non-resident taxation, the tonnage tax regime consolidated. The entire shipping tax framework is reorganized in single integrated code with clearer computation, anti-abuse rules and explicit inclusion of inland vessels without changing incentives. Shift in legislative style, the Act moves from proviso-driven exemptions to a definition-led, formula-based structure, architecture aimed at reducing litigation and improving compliance certainty. So these are the basic features of this chapter, and hope this deliberation. And my note, if you go through minutely, will speak about each section of the new law and will give you a clarity of vision. I have read out, not spoken ex tempo, deliberately, not to miss the value of each word I have put into this note. That is why I have circulated this note amongst all of you so that you can go through it. With these words, I end my today's deliberation. Thank you so much.
Thank you so much, sir, for such a detailed note. I think this will be a great takeaway for all the participants who will minutely read through this at their own pace. Now, anybody has any question? Online participants also? Any question? You can unmute and ask online participants. Okay, Sir, I have again two more questions.
Yes, sure.
Because, although it is not in your topic for today, but it was discussed during our interaction and you picked up this point with the Honorable Member, Mr. Mishra, that day. This 247 on search, which is same as corresponding to section 132. Two questions on that, sir. You also deliberated on that. This reference to black money provision, Black Money Act in search. Number one, that impact, and second, sir, now corresponding to 69A, where Supreme Court in the case of DN Singh, it has clarified that valuable article is an article which has low volume, high value. Now they have made it into asset. What is the impact of these two changes, sir?
See, as far as this black money law is concerned, this law itself is a black money law. What search you will conduct
under the black money law to find out the black money law. The moment you want to issue a warrant under the Black Money Act, you have to first of all say that Black Money Act applies to him. Then only you have to assume jurisdiction under the Black Money Act. When do you assume jurisdiction in the Black Money Act? When you receive information. Where from do you receive information? You receive information from those persons who are in the knowledge of you holding that black money abroad. So first of all, you have to, because the moment you get information, the authorities acquire jurisdiction. And in that year itself, your assessment shall have to be made. So how a DG investigation will form reason to believe that under the black money law, you have not disclosed an income which you should have otherwise disclosed. See, you may not disclose an income under the Income Tax Act. Then you come under the black money law. How do you come under the black money law to say you have not disclosed? The moment you have not disclosed, you come under the black money law. So what search? Search will be under the Income Tax Act. There they find out that you have got foreign bank account, foreign asset and all foreign transactions which you have not disclosed under the Income Tax Act, you will fall under the Black Money Act. So how Black Money Act can be the basis for conducting a search against you? That is why I asked Misra that day that I don't understand who has enacted this provision. So therefore, induction of Black Money Act in 247 provision for forming reason to believe about the undisclosed income is something totally contrary to the very section itself. So that is something my mind is puzzled. So I was very categorical to Misra. He did not respond to that. As far as the Supreme Court's judgment is concerned, DNK. What is Section 69A? Section 69 is enactment which came in the law, as law in 1964. In 1964, they found Section 68, Section 69, Section 69, Section 69B and Section 69D was not enough to cover up the undisclosed income and asset. Because when money is found, how do you assess that? So therefore, Section 69A was enacted. Now, you have got asset which is not disclosed. It will come under Section 69. Because undisclosed investment, Section 69. You have got an asset which you have half disclosed. It will come under Section 69B. What is the need for 69A? Section 69A is nothing but totally unexplained money. What is unexplained money? Anything which can be valued in terms of money is unexplained money. So therefore, this D.N. Singh's case has thrown light on the fact that cryptocurrency it's a digital asset. That is a digital asset they have covered under Section 130.
Yes.
So that comes under the now Section 69A. Like that sort of asset which can be valued in terms of money, digital asset, they are not asset like immobile property, gold, silver, all these things, because they can come under Section 69. But under Section 69A, this is the unexplained money which will be coming. So therefore, I think the whole purpose is to cover up those sort of money-related instruments.
Sir, but stock in trade?
A stock in trade is again an asset. A stock in trade is an asset.
So will that come
A
now?
stock in trade is an asset of business. And it will not come, it will come under business income. A stock in trade is a result of a profit accumulated over the years in the form of stock. So that shall come under section 28. That should not come under section 69A. There are judgment to that effect. That a stock in trade, actually I am disclosing less profit than I am earning, and I am piling up a stock in trade. So therefore, that should be assessed under section 28. Because the day it is found, it shall be assessed on that date. Unless you have evidence to the effect that that has been earned in the past. If that has been earned in the past, then you have to reopen, or you have to bring it on a block assessment, and the business income shall be computed on the basis of those accounts. So stock in trade will not fall under section 69A.
Right. So in case we have no other questions, I think we'll wind up for today. So thank you very much, sir, for this deliberation and note. I hope participants, you can go through this note. Online participants also have got this note on mail. And tomorrow, we await another intriguing session.
I'll again send you in advance.
Again, another note will come from sir, and maybe we can read that. Come prepared for more questions tomorrow.
That shall be very good. That shall be very good.
Thank you, sir. Thank you so much.